Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Small cap stocks pack a punch. These companies, typically valued under $2 billion, often fly under the radar but can deliver outsized growth for investors willing to take on extra risk. The iShares Russell 2000 ETF, IWM, tracks this space, giving you exposure to 2,000 small cap stocks in one trade. While small caps have outperformed large caps over long periods, they come with higher volatility and liquidity risks. Their prices swing more sharply, and some struggle to attract the same analyst coverage as blue-chip stocks. Still, for those with a long-term view, they're a compelling part of a diversified portfolio. Let's break down how they work. What are small cap stocks? Small cap stocks represent companies with smaller market values, often described as the underdogs of the stock market. They sit between microcaps, tiny companies, and mid-caps, established but still growing firms. Unlike blue-chip giants, small caps move faster, grow quicker, and can surprise investors, both positively and negatively. Here's the breakdown. Definition and market capitalization range. Small cap stocks typically have a market capitalization between $300 million and $2 billion. For perspective, large cap stocks, think Apple or Microsoft, have market caps over $10 billion. Mid-cap stocks typically range from $2 billion to $10 billion. Why does market cap matter? It reflects a company's size, risk, and growth potential. Small caps often operate in niche markets or are early in their growth phase. Their size makes them agile, but it also means they lack the financial cushion of larger firms. If you're looking for high growth potential with higher volatility, small caps fit the bill. The role of IWM, iShares Russell 2000 ETF. One of the easiest ways to invest in small caps is through the iShares Russell 2000 ETF, IWM. This ETF tracks the Russell 2000 index, which includes roughly 2,000 small-cap U.S. stocks. Here's why IWM stands out. Broad exposure. Instead of picking individual small-cap stocks, which can be risky, IWM spreads your investment across hundreds of companies. Liquidity. As one of the most traded small-cap ETFs, buying and selling shares is straightforward. Benchmark performance. Many investors use IWM to gauge how small caps are doing compared to large cap benchmarks like the S&P 500. If you want small cap growth without betting everything on a single company, IWM simplifies the process. Just keep in mind, it still carries the same market risks as the small cap universe. Advantages of investing in small cap stocks. Small cap stocks aren't just for risk takers. They offer unique benefits that can supercharge a portfolio when used strategically. While they come with higher volatility, their growth potential, market inefficiencies, and diversification perks make them worth considering. High growth potential. Small cap stocks often outpace large caps during bull markets. Why? Smaller companies grow faster when economic conditions favor expansion. Think of them as startups with room to scale. Many evolve into tomorrow's market leaders. Historical data backs this up. For example, the Russell 2000, tracked by IWM, has beaten the S&P 500 in 17 of the past 30 years. When small caps rally, they tend to sprint while large caps jog. Key factors driving this growth. Revenue flexibility. Small companies can pivot and adapt faster than corporate giants. Untapped markets. They often target niche industries before big players notice. M&A targets. Many get acquired at premiums as larger firms seek innovation. The catch? Growth isn't linear. Small caps can stumble, but patient investors may reap outsized rewards. Market inefficiencies and undervaluation. Wall Street analysts ignore many small-cap stocks. Why? Covering them isn't as profitable as tracking Apple or Tesla. This lack of attention creates inefficiencies. Hidden gems trade below their true value simply because few are looking. Active investors who do their homework can spot these opportunities. Examples include companies with strong cash flow but little media buzz. Stocks mispriced due to temporary setbacks, like supply chain hiccups. The upside? Less competition. While hedge funds swarm over large caps, small caps often fly under the radar until they surge. Diversification benefits. Small caps don't move in lockstep with large caps. Their lower correlation can smooth out portfolio volatility. Here's how. Different drivers. Small caps often thrive on domestic growth, while multinationals sway with global trends. Cyclical boosts. They tend to lead early in economic recoveries, balancing slower-moving blue chips. Adding small caps is like planting both oak trees and bamboo in a garden. One grows steadily, the other shoots up fast. Together, they create a more resilient ecosystem. Keep in mind, diversification isn't about eliminating risk. It's about balancing it intelligently. Risks and challenges of small-cap stocks. Small-cap stocks offer exciting growth potential, but they're not for the faint of heart. Their smaller size means they face unique hurdles that can trip up unprepared investors. Understanding these risks helps you decide if they fit your strategy, or if you're better off sticking with more stable options. Higher volatility. Small cap stocks swing harder than large caps. One day they're up 10%, the next they're down just as much. Two main factors fuel this turbulence. Lower liquidity. Fewer shares trade hands daily, so even small buy-sell orders can push prices sharply. Economic sensitivity. Small caps rely heavily on domestic growth. A dip in consumer spending or rising interest rates hits them faster than multinational giants. During market stress, small caps often fall first and rebound last. The Russell 2000, for example, dropped 35% in early 2020's crash, 5% more than the S&P 500. If you panic easily, this isn't your arena. That covers the basics of small cap stocks. Stay tuned for part 2, where we'll talk about how to invest and what to watch for in different market conditions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.